it purchases, diagnostic testing supplies to be used in the test. So basically the business is that they conduct the test and then they bill the clients for the results. Okay. So now obviously to conduct the test they buy these testing supplies, and that is their inventory. So it is the inventory that they use, but as opposed to companies like Home Depot or Walmart, they don't sell the supplies. They use the supplies in their business, and then the business generates test reports, and that is where they get their revenue from. Right? However, that doesn't change the fact that when they buy the supplies are actually inventory. Except that this inventory is not sold as it is, but it is consumed in generating sales for the company. Okay? So you understand the subtle difference between the Home Depot model that we discussed yesterday and the lab supplies model that we have today. This is more like a production model where, think about a car manufacturer. What they do, they buy these raw materials, they consume the raw materials in building a car. So it's not like it's not a dealership which buys the car and sells the car, and they don't add any value to that car, through a production process. Whereas here, you have these, inventory items called lab supplies, which are consumed in conducting the tests, and then the test results are the ones by which the company earns its revenue. Okay, so now let's say the company is buying, $150,000 of lab supplies for cash. So obviously, what we do is we first look at what is the effect on assets, liabilities, and equity of this particular transaction. So when you buy inventory for cash, what happens? You create an asset called inventory. This is inventory. It is like buying paper and pencils and say office equipment. So this is just like inventory. So we have the inventory item. There is an account under assets called inventory that will increase by $150,000. And since they paid for it in cash, cash will reduce by $150,000. So when we record this transaction, so you can see here the effect on total assets is actually zero, because one asset called inventory increases by $150,000 and another asset called cash reduces by $150,000. So the net effect on total assets is zero. So assets did not change in total, but basically one asset called cash got converted to a new asset called inventory. Right? I mean, you can look at it, just keep thinking about it in different ways. Not focus, of course, ultimately we want to focus on that equation which says that change in assets for every transaction the change in assets must be equal to the change in liabilities plus the change in owner's equity. So never forget this. Ultimately, this has to hold. But when after ensuring that this holds, remember that's an end result. This is not that, okay, we are trying to fit a transaction so that this holds. So we can put it anywhere we like as long as this holds. No. We want to put the transaction, record the transaction the way it should be recorded, and then confirm that this has not been violated. Okay, so if you start from here, then you are likely to make mistakes in terms of recording it in one account versus the other. I see this happen all the time. When I put a question like this on the test, the students are generally trying to push the answer in a direction so that this is not violated, and then they write it in whatever account that comes to their mind. Because they don't understand, they haven't understood the place where it should really stop. Okay, so here what we are saying is that, okay, what are the accounts that are involved? There are two asset accounts involved. One asset account is going down, another is going up. Right? All right. So now let's go to 6. Transaction number 6 says cost of the laboratory supplies used is $80,000. So now what happens during the year? Now that they have all this inventory, during the year they start using this lab supplies in conducting their tests. Okay? So they keep track of how much they have used. So let us assume that they have used, or as the problem says, they have used $80,000 of these supplies. So when you use $80,000 of supplies, what happens? The inventory called supplies will go down by $80,000 because you've used it. Right? You no longer have that inventory. So the inventory is reduced by $80,000, and now that becomes your expense. you have used the inventory in earning a revenue, because when you consume the supplies, you conduct the test, and then you use those test results to earn revenue. So now we have an expense, which is the consumption of this, if you will, raw materials. Okay, so you use the test supplies in order to earn a revenue. So therefore, the reduction in the test supplies is equally matched by a change in owner's equity, which is your expense. Remember, again, the owner's equity is the most complicated of all these relationships. So the change to owner's equity comes in the capital stock, which is contribution by stockholders or owners. It also comes in retained earnings, which is profits minus dividends. So let me just say, well, profits would be plus, to say that it increases owner's equity. So here this is a plus. Contribution by owners is a plus, meaning that it increases the owner's equity. Profits is a plus because it increases owner's equity. Dividends is a minus because it reduces owner's equity. But profits by themselves, we know that profits are what? Revenues and expenses. They constitute profits. Now what happens when revenues go up? Profits go up, right? Revenues bring profits to you. So, I'm sorry? Yeah, I'm saying that keeping the expenses constant, the effect of revenues on profits is positive. So therefore, when you have revenues, that increases your profits. And when you have expenses, that decreases your profits. So the owner's equity change is the most complicated in terms of our recording model here. Okay, once you go into the T accounts, that is the debit credit model, you will see that this is pretty easy to understand. But when we are starting, without the debits and the credits, you will see that this is the way, it's good to understand it visually. Okay, so we have revenues. So therefore, if you work backwards, so what happens when you have revenues? Because revenues will increase profits, and profits will increase retained earnings. And retained earnings will increase owner's equity. Same thing, expenses. When you have expenses, expenses will reduce profits. So when profits are reduced, retained earnings are reduced, and therefore owner's equity is also reduced. So expenses have a negative relationship to owner's equity, and revenues have a positive relationship to owner's equity. And dividends obviously will have a negative relationship, because as you have dividends, retained earnings go down, and therefore since retained earnings goes down, the owner's equity also goes down. Okay? Okay. So in this particular case, we have an expense. That's why I record it as a minus, because the effect on owner's equity is negative. It makes owner's equity go down, so we record it as a negative. But once we get into the debit credit system, there will be no negatives and positives. You either debit an account or credit an account. Everything is positive in the debit credit system. Okay, so we'll see that later. Okay, today. So let's move on to number 7. Again, once again, stop me if something is not clear. Okay, let's move to transaction number 7. 7 says salaries and other expenses paid in cash. So you're already told this is an expense. Since it's an expense, we know that owner's equity is going down. So that's what we have. So this is, by the way, this is a negative number here. I think the column, width made this. Let me see if I can do something. Yeah. Okay. So this negative $150,000, that is because owner's equity is going down because of the expense, and at the same time, cash is also going down. Why? Because you paid the salaries. Okay. Salaries were paid in cash, so the cash is also going down. All right, number 8.
I have a question.
Yes, go ahead.
Salaries wouldn't be considered accounts payable, right? That would
No,
be
it would be. It would not be accounts. Number 1, the answer is yes. It is not accounts payable. Now, number 2, I want to extend your question a little bit so that it clarifies it clearly. When you, in this particular transaction, you are told that the salaries are paid, which means that there is no liability, they were already paid. So that way, as soon as it is paid, it is already an expense, so a liability is not even involved. However, if the employees, and you will see another new transaction later on, if the employees have earned the salary but you have not paid it yet, sometimes your payroll ends, but the actual payment date is like a week later or something like that. So, but if you're closing the books at the end of the payroll date, then that is the amount of salary that the employees have earned that the company has not paid. Now we have a liability, but that liability is typically not called accounts payable. It's more called like salaries payable, to make it different from accounts payable. The term accounts payable is typically used only for money that you owe suppliers of inventory. People who supply inventory to you, and if you have not paid them, that amount is kept in an account called accounts payable. So you don't use the term, this is again a convention. You don't use the term accounts payable to record or to report salaries that are not yet paid. Okay? Okay, now next item. All right, 7 is done. Let's go to 8. Salaries for December 2011 to be paid in January 2012. Exactly the example now. Now we have salaries for December 2011. So since you are computing, when you compute the profits, you're looking at revenues minus expenses, and revenues include all the revenues you have earned in December 2011. So therefore, the expenses must also include all the expenses incurred in December 2011, whether those expenses have been paid or not. It doesn't matter if the expense has been paid or not. If it is a legitimate expense of December 2011, it must be included in this particular transaction. So therefore, we actually have an expense of 2011, which is $10,000 of unpaid salary. So what we do, the way we record that is, since it's an expense, we take it as a reduction in owner's equity, but at the same time, it is not paid. So you can't take it as a reduction in cash. It is the money that you owe your employees, right? And so therefore, we put it under liabilities. So that's why I'm just calling it other liabilities as opposed to accounts payable. So everything else, I'm putting it in one account. So the other liabilities are going up by 10,000. This is the amount of unpaid salaries.
So once again, that's also considered like a salary payable that you're talking earlier.
Absolutely. Absolutely. In the real world, a company would use the account called salaries payable. That's what they would use. I was also concerned about the number of columns that I would keep for this example. So I started, summarizing everything else. The unimportant ones, I started summarizing them in one column.
These are the most important ones that are going to be used.
That's true.
So
Yes.
in the event that we wanted to code it to salaries payable, and that is not an option, you're suggesting that we put it in other liabilities?
Oh, in this particular case, so if you're worried about it from a test point of view, I will give you the table with the columns. So you don't have to generate, think about the name of an account. The name of the account is already given. All you have to do is to put it in the correct column and use the pluses and the minuses correctly. That's about it. That's all you have to do. You don't have to think, whether it's accounts payable, salaries payable. That I will do for you.
It needs to explicitly say cash for it to be in the cash column or not?
No, sometimes, when I use, I fall into this, trap all the time. It's the way it is. I generally assume that once I have used the word paid, it always means cash. So therefore, if you see the word paid in a transaction, that means cash was paid. Yeah. But I will try, on a test, I will try paid in cash or something like that. But generally, we don't have accounting transactions where the payment is in something else. It's cash. Yes.
You said account payable is money you owe to people that deliver inventory, right?
Correct. That's right. That's right. The term accounts payable is used for an account that holds all those amounts. The amounts that the company owes to people who have already supplied inventory to you. Obviously, if they have not supplied it, you won't owe them the money. So the idea is they have already done their part of it. They have supplied it, and you owe them the money. So it's kept in an account called accounts payable. The money that you owe.
Thank you.
Huh? Problem. Okay, so moving on, let's go to number 9. Paid cash dividends of $20,000. Now, paying a dividend, obviously, like we discussed yesterday, is a distribution of the retained earnings. So as you can see here, retained earnings has profits and dividends. So when you pay dividends, okay, it is coming out of retained earnings. So retained earnings is going down, and since retained earnings goes down, owner's equity also goes down. So now dividends have a negative effect on owner's equity, obviously, right? So that's how the transaction is recorded. You can see that the retained earnings shows a negative number. I hope it does. Yes, $20,000, and it is a negative number in the retained earnings column. And since it was paid in cash, cash is also showing a negative 20. Now watch here. What I have done is that in the retained earnings column, the numbers that I have written, they are all followed by a letter. Since I'm combining revenues, expenses, and dividends in the retained earnings column, I have indicated each number by whether it's a revenue number or an expense number or a dividend number. So that's what the RED. It's only because only one column is capturing all the three. So I want to make sure that as you review the material, you understand, okay, that number is because it was a revenue item, an expense item, or a dividend item. And there are three different things. It's very important to understand. Dividends are not expenses. When you pay dividends to your stockholders, by then the profit is already computed. So when the profit is already computed, that means the expenses are already considered. So dividends that you pay your stockholders cannot be expenses. Okay? They are distributions of accumulated profits. So therefore, they are treated outside of expenses. Okay, so that's 20,000. So let's move on to the next, which is number 10. Prepaid a 2-year insurance premium on January 1, 2011 in the amount of 50,000. This is an important transaction that you will see again and again in this course. There are two transactions that you are going to see frequently, and I have included one of them in this example. See, when you prepay insurance, so what you're doing, since as the transaction says, you're prepaying for 2 years. So what are you doing when you pay a premium in advance? What are you buying with that money?
Coverage.
You're buying asset protection, or as you say, coverage, right? So you're kind of that payment ensures that the risk is now absorbed by the insurance company for that period of time. So you're buying something which is protection of the assets. So since the period here is for 2 years, it will not be on the day you pay the premium, it will not be considered an expense because it has not included the whole period. You're paying for it in advance. So at that time, when you pay for something in advance, you have purchased an asset. And that asset is called prepaid insurance. So like inventory, when you pay for inventory, you purchase an asset called inventory. The same way when you pay insurance premiums in advance, you are buying an asset called prepaid insurance. Inventory.
To generate something?
No, inventory.
Stop. Inventory.
So understandable that we're gonna aim for 2011. What about 2012?
We'll get to that. We'll get to that. But first, let's finish with 2011, and then we'll see what we will do in 2012. Okay. The example doesn't cover that, but remind me after we are done. Okay. All right. So now we are saying that okay, we are paid for 2 years in advance. So at the time we pay, it's an asset just like we buy a machine or we buy inventory. So what we have, so we will since we paid for it in cash, cash goes down by 50,000. And an asset called prepaid insurance will go up by 50,000. So we have this asset now at this point. Okay, at the time. On January 1, 2011, when we paid for 2011 and 2012, we have an asset of $50,000. Okay, all right. So the next one is a repeat of a previous transaction, I believe, or maybe something else. Okay, number 11. Laboratory supplies Again, assumed as inventory, purchased on account 65. Now again the term on account. On account means you have not paid for it. When you buy something on account, that means it was bought on credit. So that you have not paid the supplier for the $65,000 that you purchased on that day or in this transaction. So that's very simple. So you have an asset called inventory going up by 65 and a liability called accounts payable also going up by 65. Right? Any questions so far?
So even if you pay that, not paid for it yet, you pay it in like steps, like, financial agreement. Maybe you're gonna pay $200 a month.
That's the point. When the 65,000 happened, since you have not paid for it, that's why we record it as a liability. Now, as part of the financing, when you pay the 20,000 or 2,000, whenever you pay it, at that point the liability will go down by that amount.
And even if you make payments in short term.
Deal with it when you make it. When you make the payment, the liability will go down. That's it. Okay, and that's what 12 says. 12 says you paid the supplier 50,000. When you pay the supplier 50,000, cash goes down by 50 and your liability also goes down by 50. Right? Your accounts payable is no longer that much. It's 50,000 less. So you're reducing the liability by $50,000. Alright. Next one. Charged depreciation on the equipment on a straight line basis. This is something that we will review later on. I mean, in your second class we will talk about this. But I just thought, we should introduce this for completion's sake because depreciation is an important transaction that every company has to deal with. So what happens when you charge depreciation? Okay, what do you understand by the concept of depreciation?
It loses value.
Loss of value over time? What value are you talking about?
The value of the inventory or the.
Your asset value,
No, when you say value, what value are you talking about? The market value?
the market value.
Market, the
What
cash-
you can sell it for? Is that what you're saying?
Product value.
That's what.
Cash value.
I'm not sure.
Good, you should not be sure, that's good, it's very good. If you are sure that it is a market value, then I'll have to explain that. But if you're not sure, that's a good sign. So when you say value goes down, what is the value that you're talking
Appraised
about?
value?
Is it because of inflation?
Does it have to do with the life expectancy, like how long you expect the equipment to last?
There's-
or-
We,
There's
cons
different
we
factors.
consider that life expectancy thing in computing the 10,000. Yes, we include that, but that's not what it is actually about.
Could it be because of demand? There's not a lot of demand, so you have a large quantity of inventory and then nobody's buying it, so it has to,
No,
no?
You don't depreciate inventory, by the way.
no.
Inventory is not depreciated.
You
We
already paid for that.
depreciate
That's what I'm-
equipment. That means assets that have long
It
life.
depends. on the-
Inventory is supposed to be, or at least it is generally assumed to be used within 1 year. Within 1 year.
Within one.
So therefore there's no depreciation for inventory. Okay?
It's how much has been used, the market value, its current condition, it's,
The reposition value.
yeah.
The what?
Reposition value, how much you have to pay to get a new one or the same one, the price. There are different factors.
Yeah.
It's not only inflation, it's the reposition value, the market value, and the usage, because you already are using your tangible values. So
So it'll become more obsolete faster if it's not.
it depends on the good.
Uh,
'Cause-
competitive.
Depreciation is simply allocation of cost. That's it. Nothing else. It has nothing to do with market value. It has nothing to do with, it has to do with the use, but you don't have to measure the use in order to charge depreciation. What is depreciation? Okay, think about it. Okay, we'll start, from, just conceptually. Here you have an equipment. Okay, you bought some laboratory equipment, right? So let's say it's an X-ray machine. Okay. So you expect it to have a life of, let's say, 10 years. I'm just pulling some number. You expect that it will last 10 years. What does lasting 10 years mean for your business?
You don't have to purchase another one for another 10 years.
It's about a lot of
That's
value.
one.
A lot of value.
But what does that have to do? You are using that equipment for 10 years to earn what? To earn revenues. That is the key about depreciation. It is you are using that equipment. So your point about the use is valid, but it is the use that is linked to the earning of revenues. The point about depreciation is that here is an asset that's got 10 years of life, and that's an assumption. Nobody knows that it will actually fail in 10 years. It may fail in 5 years, it may fail in 15 years. You may continue to use it happily after 10 years too, no problem there. But you have to start somewhere. So we assume that it has a useful life, some reasonable estimate based on the nature of the equipment. So you say, but the key is that the fact that it has a life of 10 years in your assumption means that you are using it for 10 years to earn revenues. So now comes the matching. Now you're saying, all right, I'm using this asset, I've already paid for it, but I'm using it in order to earn my revenues, and my revenues get counted each one of those 10 years. Where is the other side, the expense side? When I bought it, I thought it was an asset, so I put it as an asset. I didn't call it an expense, I put it as an asset. It's an equipment, it's sitting there as an asset. But every year I'm using it to earn revenue. So some part of the cost of that asset must be matched against the revenues in computing my profits. I mean, I'm taking my salaries as an expense, I'm taking my utilities as an expense, I'm taking cost of goods sold as an expense. What about the use of this equipment? So if I'm having an office in a building and I bought the building, obviously I'm using the building to earn revenues. I'm having office there. So that is part of my revenue earning process. I'm using that to earn revenue. So what do? I depreciate that building and match it against the revenues each year to compute my profits. Then my profits are a complete number. All expenses incurred in earning my revenues are matched. Expenses like cost of goods sold, the supplies that I use, that's matched. Salaries are matched. Utilities are matched. Taxes are matched. Everything is matched against revenues, but if I don't depreciate the equipment, a very key ingredient of expense is not matched against my revenues. So my profits are overstated if I don't depreciate my asset. So that is the reason we depreciate the asset. And down the road you will see there are multiple methods of depreciation. There's only one method that we are going to see where the depreciation is charged based on the extent of use of the equipment. In all other methods, depreciation is charged simply by passage of time. So if you say 10 years, straight line says take 1/10 of the cost and make it depreciation expense each of those 10 years.
So you have two ways. One is how much you use it, and the other way is how long the lifespan.
Yes, that's correct. That's correct. Well, the lifespan will come into place even based on how much you use, but the point is that even in that method, every year's depreciation is based on the extent to which you have used that machine that year.
How do you marry it to revenue?
How do you what?
Marry it to revenue. Like how do you said everything's tied into revenue.
It's not tied in, it is matched. Just like expenses are matched, just like cost of goods sold is matched.
When
The-
in
the-
your spreadsheet, everything's matched. Like you got 50 million, 50,000 in, you take out 50,000.
No, that's not the matching that I'm talking about.
That's
When
what
I
I was
say-
asking. 'Cause
When we use the term matching, we are talking about revenues and expenses in the same period. In the year 2011, we've already computed that $350,000 as revenue. Then we look at all the other transactions and say, what are all the expenses that we have incurred in earning the $350,000, and depreciation is one of the expenses. If you don't charge depreciation, you will leave that out, and your profits will be too much. And it will be wrong, obviously, yes.
So when you're talking about depreciation of the asset, are you talking about predicting time that you're not using it to earn revenues?
You can't do that. It's very difficult. It's very difficult. When I choose the method, typically we choose the method for the company as a whole. Okay? And once the method is chosen, then really we don't ask, okay, let us say that we do straight line, like we are talking here. So we are saying, okay, 10 years straight line. That means 1/10 of the equipment cost becomes depreciation expense for each of the next 10 years. So the equipment is fully depreciated in an accounting sense in a 10-year period. that doesn't mean it's worth zero at the end of 10 years. At the end of 10 years, you may still be using it, or you may sell it and make some money out of it. It doesn't matter. But the point is that you have made sure that the cost of the equipment has been matched against revenues over the life of the equipment. You paid whatever money you paid to buy it.
What happens after 10 years?
So then at the end of 10 years, whatever the useful life that you assume, at the end of 10 years, you have made sure that the money you spent in buying this asset has been matched as an expense against all the revenues earned in those 10 years, because you assume that this equipment has contributed to earning the revenues. So therefore, there must be a match of the use of this equipment. And this is just a convenient way to measure the use. It's not the perfect way. Certainly not. Yes, now.
So accumulated depreciation after 10 years, you're in balance of zero.
No, accumulated depreciation will be equal to the total depreciation that you have charged. So you will see that if, let us say you start to assume that there is nothing, there is no value after 10 years. So at the end of 10 years, your accumulated depreciation will be exactly equal to the cost of the asset, which means that the accumulated depreciation will tell you that you have fully depreciated the asset.
So zero.
No, accumulated depreciation is not zero.
It's a reduction.
The book value is zero. The book value is the cost of the asset minus the accumulated
So you
depreciation.
can't keep it on your sheet.
You can, you will. It will stay in the sheet as long as the equipment is being used. If you don't junk the equipment or if you don't sell the equipment, both the equipment and the accumulated depreciation will stay there.
And what would be the numbers that you have?
You won't use it. You will not depreciate it anymore. So it will just, you will leave the equipment at 80 and the accumulated depreciation at negative 80, whatever the number is, and it will stay that way all the way until the equipment is junked or sold. So what we will do is we will depreciate the equipment. It's an expense, and at the same time we are going to reduce the assets, but not the equipment itself. So we'll put it in a negative asset. We call it contra asset, and that contra asset is accumulated depreciation. So we'll start putting this 10,000 into accumulated depreciation each year for the for the life of the equipment. So here we said, okay, 5 years, no salvage value. So 50,000 divided by 5 is 10,000. So every year the equipment will be depreciated $10,000, and at the end of 5 years, the accumulated depreciation will show a negative 50 in this table. So the equipment is showing 50, the accumulated depreciation is showing negative 50. So in the books, under assets, excuse me, this equipment has no book value. But it may be still giving you revenues because you're still using it. That's fine. That happens. Yes.
So, in the same manner in which you prorated the accumulated depreciation, can you do the same thing with the prepaid insurance?
That's exactly it. Now you got it. Perfect.
Explain it to me,
Perfect.
I don't get it.
Perfect. That's exactly right. You just went to the next step before me. That's exactly what we did with what we are going to do with prepaid insurance. Now that should answer your question. So now at the end of the first year, your prepaid insurance is no longer the 50, it's only 25. Because now you have only one more year of asset protection, and that's only $25,000. So you will reduce prepaid insurance by 25 and call that an expense. Because you have consumed it, you have used it. You have used that protection. So therefore it's an expense for this year. Right? Very good. Very good. So I don't have to discuss 14. Good job. All right.
Sorry.
No, that's why are you sorry? Actually, I'm thanking you. I don't know if you got that or not. I'm actually thanking you for sure.
No, she's the only one that, well,
No, she's not
I
the
didn't
only
get it. I'm sorry, Sandra. I don't know.
All right, here we go.
Because
So
you
now,
paid it.
now, okay. So now what do we have? We are done with recording all the transactions. They're all done. So now we can start with the financial statements. So how do we get the financial statement? And this is really the nice part about this. If you did the table right, the financial statements are extremely simple to extract. The first statement that we extract is the income statement, where you get the profits. So where do you get it from? Just this one column, the retained earnings. You just look at that column, take all revenues and expenses, just leave out the dividends. That's your profits.
So anything with a D, leave out.
Yeah, anything which has dividends in it, it's not an expense, so you got to leave it out. Remember, retained earnings has what? Profits, which is revenues minus expenses, and dividends. So in this column, the retained earnings column, look for everything that's a revenue and an expense, and you're done. And that's what you will see in the income statement. So why don't you look at it in your own files and convince yourself that, oh, what did I do? Ooh, oh, I forgot, this is not an Excel file. Okay. Alright, so, alright, take the retained earnings column and look at all the numbers there, and then go and verify that the income statement is indeed correct, because it takes the revenues and it takes the expenses from that column. That's it, that's all you need to do. And you are giving each one a name, what that expense is. In the column we don't have a name, but here we have everything. Each one is individually identified as an expense. Go ahead and verify that. Make sure that you are comfortable with it.
I concur.
I'm sorry?
I concur.
You concur? Excellent, excellent. Anybody has a problem with the income statement? So we have the revenues and we have all the expenses, and there you go. The total expenses are there, so your profits are 75,000. So profits for the year 2011 are 75,000. Watch this carefully. It is income statement for the year 2011. That means it's for a period of time. Okay. So we have the profits. Then we go to the yeah.
So it says net income.
Net income is profits.
It doesn't, like, you know, I'm used to my salary. It has gross and net. We don't do gross in this?
There is nothing called gross income. The only thing that comes close to a gross income is revenue. So you start with the revenues, take out all the expenses, and you have your net income, which is profits. So when you say net, I mean you're saying salary, okay? The point about the net in a salary is what you have on hand after all the deductions that took place. So it's not, you know, for a year.
Okay, so gross would be the same thing. Like, I would get a salary, but after all the deductions, it's my net income. I didn't make that kind of connection in my brain.
No, it's a wrong connection. I want to say that clearly. It's a wrong connection. So, you know, if you continue to think like that, then more likely than not, you will make a mistake.
Okay.
Some deductions that are done in your salaries, they are really not expenses for a year. You can think of your salary as income. The deductions that are made on your paycheck, some of those deductions may be for a loan that you have borrowed from your company. So you are paying it back through your salaries. So first you borrowed the money, and then they kind of take it back from you through every paycheck, based on an agreement that you may have with the company.
Right. That's
That's not an expense for you. That's simply borrowed money, giving it back to the company. There are some things where it is, some of the deductions are not expensive. That's all I'm going to say. So while the term net has to do with gross salary and deductions, and therefore net salary, that part is correct. But to treat every deduction as an expense for you is also not correct. But primarily they will be expenses. Okay? Good. All right. So we have our profits, which is net income, $75,000. And then we do the statement of owner's equity. This is something that we didn't do in the past, but we'll just do it now. So statement of owner's equity simply says, take the two accounts that we have under owner's equity, show how they changed during the year. So the capital stock and retained earnings, they started with zero balance before all these transactions. So they started with zero. Then during the year, the capital stock got $600,000 in because of contribution by owners. That's all there in the recording. If you go back to the table, you will see a positive 600 in the capital stock column. And so it ends with $600,000. With retained earnings, what do you have? You have zero to begin with, But now remember, what do we have in retained earnings here? It's your profits and your dividends. So profits add to the retained earnings, dividends will reduce retained earnings. In this particular year, what we have your profits of 75,000, we got it from the income statement. So your profits went up, made the retained earnings go up by 75. The dividends made the retained earnings go down by 20. So you're ending the year in retained earnings with 55,000. So retained earnings ending is $55,000. And that is something you can easily verify. I didn't put it in here, but if you just add across here in the column, and you start with the 350 and then do the pluses and the minus correctly, you will see that it ends with 55,000. So the retained earnings at the end of the year is indeed 55. Now the best part is of course the balance sheet. The balance sheet is already done. Why? Because all the assets are already listed here, and all the liabilities are listed, and the stockholders' equity is listed. All you have to do is to just add across in the column and say, okay, what it is in each column. So that's what we have here, and I'm going to give you about 5 minutes to verify the numbers. You should verify the numbers. For your own good, you should make sure that you understand. I mean, I know that they are right, but you must be comfortable with exactly how the numbers came by. So I'm saying that cash is showing 390 at the end of the year. Accounts receivable is showing 90, like that. So go ahead, take about 5 minutes and verify every item on the balance sheet from the way we recorded it in the column. All you have to do is to add across in the column itself. Okay? Make sure that you're completely comfortable with that with those numbers.